The Pacific industrial and logistics market carried positive momentum into 2026, following a strong fourth quarter of 2025. This provided an encouraging foundation as the year commenced, reinforcing the view that underlying occupier demand, while selective, remains active and engaged. Q2 brought a change of pace. A more complex and uncertain global political backdrop prompted many occupiers to pause and regroup. A vast majority of active briefs elected to renew rather than relocate, with cost containment and uncertainty winning over disruption. We don't view this as lost demand, we view this as deferred demand. The majority of this cohort is expected to re-engage within the next 12 to 18 months, representing a compelling pipeline of future leasing activity that underpins our positive medium-term outlook. The transactional activity across the first half of 2026 has reinforced that occupiers remain focused on operational functionality and will commit when the commercial terms stack up. Landlords who have met the market through competitive incentives, early access and meaningful fit-out contributions have been rewarded with leasing outcomes, while secondary grade assets continue to face the greatest pressure, though motivated owners and realistic pricing are continuing to find a market. From a demand perspective, the market is experiencing a shift in active occupier cohorts. The third-party logistics sector, which has historically been a primary driver of large format leasing activity, remains subdued as operators continue to absorb existing capacity and resist committing to additional space in an uncertain freight and consumer environment. In contrast, demand linked to the data centre sector and its broader supply chain has emerged as one of the most active sources of inquiry across the market. Occupiers operating in data centre construction, fit-out, equipment supply and critical infrastructure services are actively seeking facilities that can accommodate their specific operational requirements. And this cohort is expected to remain a meaningful contributor to leasing activity throughout 2026. Complementing this, the manufacturing sector has demonstrated encouraging levels of activity, with operators specifically targeting facilities that offer adequate power supply, gas infrastructure or crane capacity. This infrastructure-led demand profile is reshaping the way landlords and developers think about asset specification, with power availability and structural capability increasingly becoming a primary leasing criteria rather than a secondary consideration. Vacancy rates remain low by historical standards, and the combination of deferred demand returning to market, a diminishing sublease pool, constrained new supply, and a sustained preference for high-quality assets, the Pacific industrial and logistics market is well positioned for a return to more active conditions, with ingredients for meaningful recovery and take-up firmly in place over the medium term.